In a lot of divorces, the two options people hear about first are selling the home and splitting whatever's left, or having one spouse buy the other one out. And if you're anywhere near retirement, neither one feels great. Selling means starting over in a housing market that looks nothing like the one you bought into, and a brand new 30-year payment on one income at this point in your life. That's a hard thing to take on. But for homeowners who qualify, there's another financing tool worth putting on the table. It doesn't replace legal advice and it doesn't work for every situation, but it's one more option, and it's one that's often not explored early enough in the divorce process. In this video, I'm going to walk you through how the spouse keeping the house may be able to use a reverse mortgage toward buying out the other spouse's equity, and how the spouse who's leaving can use a reverse mortgage for purchase to buy their next home. I'll cover who qualifies, what this option does and doesn't cover, and why the lender and the product you choose can actually change what's possible here. Here's what makes divorce after 60 different from a divorce at 35. When you're younger, you've usually got 20 or 30 years of income ahead of you to rebuild. At 60, 65, 70, that runway is shorter. And for a lot of couples, most of what they've built over the marriage isn't sitting in a brokerage account, it's sitting in the house. So when a divorce puts that house into the settlement, you're just not dividing an asset. You're dividing the thing that was supposed to carry both of you through retirement, and that changes what's at stake. This is a situation a reverse mortgage was designed for. It gives you access to equity that's built up in the home without required monthly principal and interest payments. That doesn't mean there's no cost. The loan balance grows over time as interest, and for a HECM, mortgage insurance charges accrue. And the spouse keeping the home still has to pay property taxes, homeowners insurance, HOA or condo dues if they apply, and keep the house maintained. Those obligations don't go away. What goes away is the monthly mortgage bill. Now let's talk about which product actually applies to you, because this isn't as simple as one age cutoff. If you're 62 or older, you qualify for a HECM, a home equity conversion mortgage, the FHA insured version. You may also qualify for a proprietary reverse mortgage from a private lender, and it's worth comparing both because proprietary products can sometimes provide more proceeds than HECM, especially on higher value homes that exceed the FHA lending limit. If you're 55 to 61, proprietary is your only path in, since HECMs require you to be 62. Either way, this isn't a one age, one product decision. It's worth running the numbers on more than one option. One more detail that matters here, and I'll come back to this when we talk about Linda. On a HECM refinance, there's a limit on how much of your available proceeds you can access in the first 12 months, generally around 60% of your principal limit, unless your payoff qualifies you for a higher amount. The rest becomes available after that first year is up. That is specific to refinance transactions, and it's a big part of why the product and the timing both matter here. Let's make this concrete. Linda and Robert have been married 30 years and they're getting divorced. Linda wants to stay in the house. Robert's name is on the title too, so part of the settlement, Linda owes him his share of the equity. If Linda qualifies, she may be able to use a HECM or a proprietary reverse mortgage to refinance any existing mortgage and generate funds towards Robert's buyouts. Here's where it gets specific and where working with a broker instead of one single lender actually matters. On a HECM refinance, that first year access limit I just mentioned applies, generally around 60% of her principal limit, available at closing and within the first 12 months, unless the buyout qualifies her for a higher amount up front. If it does, the lender can release more of it right away instead of making her wait for the second year. Whether a divorce buyout qualifies for that higher amount up front depends on the lender's own guidelines, and I've seen this handled differently across the wholesale lenders I work with. Some will accept the final divorce decree itself as the payoff demand and approve the higher amount on that basis. Others require that a lien be recorded against the property with potentially other conditions tied to that. And they'll want the divorce decree to state clearly and without ambiguity that the home was awarded to Linda. Some lenders will even waive the HECM counseling requirement for Robert if he's quit claiming his interest at closing. This is exactly why the settlement language matters so much, and it's also why proprietary is worth comparing here too. Not just for someone under 62. Many proprietary products don't carry the same first-year access limit at all, which matters a lot if Linda needs a large lump sum available right at closing to complete the buyout. A few other things that affect the numbers, regardless of which lender or product you use. Any existing mortgage on a home has to be paid off at closing out of the same pool of funds. Closing costs come out of that pool too. And the property itself has to meet program standards. So if it's a condo, a manufactured home, or there are title issues to clean up, that adds another layer of review before you know exactly what's available. On the HECM side specifically, it's a non-recourse. Linda will never owe more than the home is worth when the loan is eventually repaid, no matter what the balance grows to. That protection is real. It just doesn't remove the need to get the numbers and the paperwork right before the settlement is signed. If you're navigating something like this right now, go ahead and subscribe, because I'm going to keep covering the pieces of divorce that don't get explained well by anyone. Now, Robert, he's getting his share of the equity, but he still needs somewhere to live. And the last thing he wants after divorce is to walk straight into another 30-year payment. This is where a reverse mortgage for purchase comes in. Robert can put the settlement funds towards the purchase of his next home and finance a portion of the remaining price with a reverse mortgage instead of a traditional one. It's important to understand that the reverse mortgage only covers a percentage of the purchase price based on his age and current rates, not the full amount. He'll still need to cover the difference between that and the total purchase price and closing costs. So this isn't a zero cash transaction. What he avoids is a required monthly mortgage payment going forward. And on the purchase specifically, there's no first year holdback the way there is on Linda's refinance. Whatever percentage he qualifies for, all of it is available to him at closing. Same qualification rule applies to here as it did for Linda. 62 or older, he's eligible for a HECM for purchase. He may also want to compare a proprietary purchase product, especially if the home he's buying is higher value, since proprietary can sometimes stretch further on proceeds. If he's 55 to 61, proprietary is his only route. Either way, the goal is landing Robert in a home that fits the retirement income he actually has, not the one that's fighting against it monthly. Step back and look at the full picture. Two separate reverse mortgages solving two separate sides of the same divorce. Linda may be able to stay. Robert can move into a new home without recreating the exact payment pressure the divorce just relieved him of. But there's a trade-off worth naming honestly. Keeping the family home can feel familiar and comfortable, but it also concentrates a big share of Linda's retirement assets in one property. That's worth weighing against her overall cash flow, healthcare plans, and how long she actually wants to stay in that home, not just whether she can technically afford to keep it. So for the right household, a reverse mortgage can be one way to structure a post-divorce housing plan without adding a required monthly principal and interest payment. One spouse may be able to stay in the marital home and use available proceeds toward an equity buyout. The other may be able to use settlement funds plus a reverse mortgage for purchase to buy a new primary residence. But it only works when the numbers, the property, the age requirements, the settlement language, and the right product and lender all line up together. And that last piece is exactly why it helps to have someone shopping this across more than just one lender and product. This is educational information, not legal, tax, or investment advice. A reverse mortgage is a loan secured by your home. It's not guaranteed to cover a full equity buyout, and you're still responsible for property taxes, insurance, maintenance for as long as you own the home. Before any of this gets written into a settlement, talk to your divorce attorney, a tax professional, and a licensed reverse mortgage professional together if possible. If you want help figuring out whether this fits your situation, book a call with me at joshborba.com/meet, and we'll walk through the numbers on which product and lender actually fit your case.